Afternoon, everybody. Welcome back to the Opportunistic Trader. We now are joined by Tony Greer of TG Macro. How's it going, Tony?
Hey, what's up, Mike? How are you, man?
Good, good. Active markets. Yesterday was straight down, today straight up. What do you make of everything that's been going on?
Signature bear market price action is what I make of it. It's definitely a bear market rally back to resistance. If they come in today and they don't have follow through sellers, we had 80 companies reporting today. I haven't combed through, the wreckage, but when you have a name like Twitter reporting, coming out with good earnings, apparently, I didn't think they sounded that spectacular. But that stock's up to
15%.
15% into resistance. Um, Whirlpool is up 7.5%. Microsoft is up 6%. And then you got this huge FANG bounce, which is really kind of puzzling me, but because I thought FANG was really going to be a one-way train lower. But these stocks are still sought after, and they're still being traded by a lot of people in a lot of different capacities. And people are still want to take a shot and buy them at these dangerous levels, even though it feels like this is the kind of turn that we're seeing that should pull the market back considerably. I still have 2,600 as my first target for this particular pullback, and I still want to sell rallies all the way up to 2830. So I feel like the wheels are in motion to bring the equity market a little bit lower due to the higher yields and due to a few other things. And we've got it's being led lower by the smaller market cap stocks, and so I think that could be a signature for the next couple of quarters. And I think that's what could lead the S&P a little bit lower. But I still think that you can trade, there are long trades to be had. There are still places to press your shorts. There are places where I'm covering my shorts, like I've covered half my builder short. I nibbled this afternoon on my social media short just because it feels like, if the traffic's going to be north for a couple of days, then I'll put it back out, at 30 or 31 and, keep trading around things that way. But I don't know. I feel like there's opportunity everywhere I look. I feel like there's opportunity everywhere I look.
Well, you mentioned right there, this that yields might be what's driving this market lower. But, two things, I'll get to that. One, it's remarkable how quiet every other market is other than equity. So like yields are doing nothing today. It's up, yields are up 1 basis point. Gold is up 40 cents. Crude's up like 30 cents. Just not a whole lot going on. Dollar's a touch higher, but nothing aggressive, and that had the ECB with it as well. It's really equities. But, you mentioned getting back to the yield side. Here we are, the 10 years at 313. It's nothing crazy.
No, no, but what we're working off of is this higher vol regime, Mike, that in the equity market. And that's why, obviously that everyone's focus is here. When this thing pops from 10 to 25 vol, everybody's got to pay attention. And when the 30-year yields go from, 3 to 3.25, portfolios start getting adjusted. So, as portfolios get adjusted, it seems like, to be honest with you, in the last couple of days that somebody probably either blew out of a fund or blew out of a position, with the heavy level of selling we saw yesterday. We saw another huge day of selling pressure on October 11th when the S&P fell below the 200-day moving average for the first time. These days when you see the tick index trade minus 1,500 or minus 1,700, that there's nothing trading but bids, and that's because guys are just liquidating positions without being price conscious. And then once that lets up, you have days like today where, when somebody completes their sell order and you get a couple of stocks, report decent quarters and get them running on the upside, then you see a retracement rally. But I'm still looking to. I still think the S&P works its way lower, and I'm still looking to take some shots. Once these sectors get themselves off the mat into some respectable resistance areas.
Yeah, well, just looking at the price action of the S&P for the past month or two, we traded down to like 27.12, then back up to 28, like 15 or 18, then just yesterday down to 26.50. So in these sort of moves, you get these sort of large retracements and large moves in both directions.
Yeah, well, when you have that steep move lower, and you look at a chart, there's no chart that really just, falls apart to zero in a straight line. So in between these steep down days that carve new lows in moves of large magnitude, they're just not going to keep having days like that over and over again. It's just not mathematically possible and not, situationally probable. But when you take a step back, even on days like this, that the Dow is up for whatever 300 point, can you see 300, 400 points, it hasn't changed anything about the pattern to me that looks like the S&P is going to curl over and trade to a little bit of a lower level of 2,600, and then we'll see. But I think it all right now depends on whether, if FANG gets a boost, Google's reporting, Amazon's reporting. If they get an excuse to get up and rip those after earnings, then, it'll be a little bit longer before the market backs off. But I think that we've seen the highs of the year and that there's a bigger probability that we end the year down a couple percent.
Yeah, it's actually on my radar right here. I'm an FX guy, and the dollar FX's G10's been doing nothing. Very, very quiet. That said, quietly, we are within like a tenth of a percent of the high of the year in the dollar index.
Yeah.
And that's quietly it's starting to grind. And if we were to really start to move a few percent, that's also something that could be a headwind.
Yeah, you can't fade King Dollar. I have not, and I will not during this administration. Trump is just kind of tightening the reins around here, and making a more efficient economy and making a little more efficient trade deals. So I expect that to benefit the U.S. I expect that to draw capital, and I still, everybody is really, really rooting against this bond position short, the big spec short in the treasury market, and thinking that yields are going to go lower, and all of a sudden I hear all this recession chatter, but the data still doesn't seem to match for me. I mean, I still don't see any signs of the U.S. economy curling over in any way. I know we may get dragged lower by the little bit of a weakness that we're seeing in Europe, the weakness in Japan, but it still looks like things are getting better here for the most part of the U.S. So I can't really look for a recession like the whole rest of the world, or a big rip lower in bond yields. I'm just not there yet. I'm still looking for higher yields.
Yeah, did you take a look at Draghi today? ECB comments. Nothing too surprising out of them. He did talk about protectionism a bit, being a possible headwind, but they don't seem like they're doing anything aggressive. Whereas the Fed, right now, we're priced for I think about 3 to 4 more hikes over the next 12 months. We got one more coming up in December, and then about somewhere between 2 and 3 next year.
Yeah, well, my next point of contact with the ECB is going to be next August. That's August of 2019. So that's the next time I'm going to check in and see if they make a rate move, because they've pretty much said in the last 3 or 4 statements that they are going to keep rates unchanged through the summer of 19. And I pretty much take it off the radar and want to just sell the currency when I hear things like that. So they've made it pretty clear that you are not to expect any rate hike changes over there, and that the economy is sucking wind in a couple of areas. They've still got all kinds of toxic debt on the balance sheets in the European banks, and I think that that's their biggest reason to keep rates low. If they raise rates on that, then the interest payments on all of that bad debt goes higher, and they have a bigger problem for the European banks, which are already in hot water, as you can see with Deutsche Bank falling off the screen this week after reporting to a new low, and kind of literally barely getting off the mat at where is it last 8 and change last. I mean, Deutsche Bank looks like an absolute disaster.
Well, it's been a disaster for years. It's been each year for about a month or two, everybody's talking about it, and then quietly kind of just doesn't do a whole lot for those other 10 months. But yeah, it's been, a lot of issues over there. And with those European banks, and, it shows that the price action in those European banks is really ugly.
Well, there's going to be more ugly price action here in the U.S. banks, because the Goldman Sachs is curling over through a monstrous, monstrous support level. And if it starts tacking towards 200, man, look out below, because there's like a double head and shoulders pattern up at the top of Goldman Sachs. There's like a head and shoulders with a little tiny head and shoulders on top of the head. So, we're trading down through the neckline now, which is around 220, down into the 200 and teens, 215 last. And it just looks like this thing is going to be in a lot of trouble in the coming weeks. if I'm any kind of technician, I mean, I'm getting a little nervous for this thing. So, well, let's see what happens. That's where I have a lot of my focus. One of my positions on my position matrix is short IAI, which is the broker dealer index, essentially, which is curling over like a textbook chart below the moving averages. And we got short that up in the mid 60s, and here we are in the mid 50s, and I'm looking for the low 50s to cover.
Sorry, technical issues there. So IAI, I'm just pulling that chart up right now. What's mainly comprised of IAI?
It's all broker dealer. It's like, Goldman Sachs, Morgan Stanley. Hang on, let me get it up in front of me here. It is 10% Goldman Sachs, 9% CME, which is an absolute juggernaut in this ETF. Then it is 9% Morgan Stanley, 8% Charles Schwab, which is curling over. The Intercontinental Exchange, which is up and to the right, and then there's TD Ameritrade, CBOE, E-Trade, Raymond James. The basic deal here is that the exchanges continue to print money and work their way higher while the broker dealers continue to curl over. There's lack of loan growth, there's lower trading volumes and all kinds of stuff that they're battling. So we'll see what happens, but I think it's going to be a good short for the last quarter.
What are you most looking forward to after the bell in terms of earnings?
I guess I'm gonna pay attention to Amazon and Google since I have a short on in the social media ETF. I'm definitely gonna pay close attention to the Google news. Amazon, I can see why they probably took it and ripped it today. It was because even though I think the stock has seen its high maybe of all time, and I know that's kind of aggressive to say, but I feel like if they don't come out and destroy earnings today, that they're going to bury the stock no matter what. And even if they do, it might be a big selling opportunity. So, I'm going to look to trade these pretty aggressively tomorrow based off of earnings, despite, depending on where they open up. Some of the best plays you get in the markets are like a day like today, where you had a chance to sell Twitter right up against its 200-day moving average. And that was the high of the day. You get opportunities like this all the time during earnings season. So I'm just looking for those in whatever reports after the bell and see where they dislocate tomorrow.
Yeah, no, it'll be interesting today after the bell. We got a lot of big names: Intel, Amazon, Google, amongst the biggest. But a lot of names, I think today they said is the biggest day for earnings. So a lot to talk about there. Anything else that's sticking out at you? Any sectors that you see this bounce? Like what are maybe 2 or 3 sectors that you see this sort of bounce and you want to add to a short or initiate if you hadn't put on a short?
That's a pretty good question. I'm kind of comfortably positioned. I'm more looking to cover some of the ones that I am short, and then that's what I've been doing. And I'm kind of sitting with the ones that I'm already short. There's nothing that I've been adding to down here. If anything, I'm actually shopping around to buy a couple of things. I'm looking at the IHI, which is the medical devices sector. And I keep a monthly performance rating in my institutional product where I kind of watch all of these ETFs. And I've been watching this one for months and months and months. And it's finally given me a pullback to buy. So I'm thinking about investing in this one and buying some calls if it looks like it's going to hold this 200-day moving average, because you rarely get a peek at it. This is made up of Medtronic, Abbott Labs, Thermo Fisher, Danaher, Stryker, Boston Scientific. I'm not familiar with even many of what these names do. I know a couple of their products, but I just like the way this thing trades. I like the way it performs. And if the market does happen to hold around here for whatever reason, this thing is going to rocket right back to the highs. So that's what I'm looking at.
Yeah, I know you speak to a lot of different people, traders throughout the day, things like that. What do you get the sense people are heavily positioned at the moment?
They're cautiously hanging on to their equity gains and trying to decide if they should, buy, sell, or hold into the quarter. But I got a feeling with the S&P, sort of hovering around unchanged, and everybody long, and there's no way that people got enough time to adjust their portfolios for what just happened in the last 2 weeks. All the selling has happened in the last 2 weeks, and you just have to think that while the market digests this over, it takes a while for the market to digest the selling. It feels like this is going to send it lower, like it hasn't really come roaring back in any way, shape, or form. So, I'm looking to sell. I mean, all rallies towards 27.75, 28.30. And that's it. I think I think it really could catch people surprised how much volatility we might see into the end of the year. So I'm pretty much strapped in every day.
Yeah, absolutely. It looks like with this volatility, you got to be. I mean, we're down a few hundred points yesterday, up a few hundred points today. We'll see what stories they have to throw. And that's part of it also, what I just said, stories. There haven't been that many stories with, downside catalyst or upside catalyst. It's really just been price action, and it's really been equity centric.
Well, yeah, McDonald's is one though. McDonald's reported, and they're like a dollar from the all-time high. The stock literally just can't be stopped. Even in this downdraft, this thing went the opposite direction, and that was pretty unbelievable performance, if you ask me. Also, the aerospace and defense stocks are, really, really volatile, really, really interesting, and really moving the Dow around here. You got names like Boeing that really haven't budged. And then you've got Lockheed that's really backed way off. So I'm curious to see what happens in aerospace and defense, because I think if that finally curls, if you look at the ETF itself, ITA, it has broken all the moving averages, all of the steepest trend line, and looks like it wants to head lower. And that thing will knock the crap out of the Dow Jones and S&P if that starts heading lower. So I've got an eye on aerospace and defense too.
I have one question. Amazon is reporting tonight, and I think they're looking for $1 billion profit or something.
Mm-hmm.
Obviously it'll be probably 2 or 3 or whatever they'll pull. But my question is, like, it almost has the same market cap as Apple, give or take, 100 billion. But Apple makes hundreds of billions of dollars, and I'm not understanding. Like, what are they like? How is Amazon doing the kind of business that they do with really negative margins or very skinny margins ever going to be in a position to make, a business that makes, hundreds of billions of dollars in gross revenues? I'm just, that's the one thing. And I get it. They're looking at the future, but really their future is just contracting by knocking everyone out of the ball game by selling stuff for almost a loss, So I was just wondering your thoughts on that.
I don't have a great explanation at all, Larry. I'm going to disappoint you tremendously there. It's an anomaly to me since, it took off and started doubling and doubling and doubling. I have no idea what they're paying for. You know what I mean? They're just starting, I guess, to turn a profit, and they haven't for years and years and years. And, they literally occupy, now they're at 50% of e-commerce. So I don't know. I guess the exposure, I don't know where it is. I don't know what the value is. I really don't.
I was just thinking about it, not even like for a trade, but I was saying, like, I understand in a way the iPhone, like I bought my iPhone because I had to get a new one for over $1,000. I mean, it probably cost them $100 to make this phone. And then on top of it, I'm paying for all these services, on top of it to Apple. And I understand how that makes a ton of money and all profits. But when I ship through Amazon or do business at Amazon, it's literally almost for free. I mean, I feel like I'm getting like the craziest deal ever. So I'm just trying to understand how they can turn that model into something that's going to be hundreds of billions of dollars. At some point, they're going to have to prove that. So.
I'm with you, man. I'm with you. I wish, it's piqued my interest enough to, at least there's got to be some kind of an elevator speech explanation for that. You know what I mean? Like, I don't know whether it's price to cash flow that it's trading more off of.
And then no matter what they come out with today, whether they make $1 billion, $2 billion, whatever, these guys just buy it. And, I just don't, again, listen, price action dictates everything. So you can't say anything, but I'm just not, I'm in another business that uses a lot of Amazon, and it's, they're killing FedEx, they're killing everyone, but they're killing it at like a rate where they can't make money. They can't make money.
It's absurd, man. It's absurd. But let's not forget that Jeff Bezos was on the cover of Forbes with the Bezos Unbound article on September 30th. And that was the last time Amazon was seen above 2,000.
Is that the Sports Illustrated curse?
Oh yeah, man, up to the day, dude. To the day, those still work. Believe me, they still work.
You never want to get on the cover of Sports Illustrated. Ask the bird, Mark Fidrich.
Yeah, right.
Amongst others, but no, I was just wondering your thoughts on. I was wondering your thoughts on that, and
I don't have anything brilliant for you there, Larry.
Yeah.
Unfortunately,
no worries. I just, and like another thing that's funny about it, like if the stock wasn't up 100 today, everyone would be nervous into earnings, and like since it's up 100, everybody's okay, or 120, know, and but again, I agree with your view. It's a bear market rally. It could go a little farther, but the market will finish down this year. I'm sticking to that conviction. I'm not letting one day really chop me up. But the only thing that concerns me is, like yesterday, there's an office, I'm not going to name the brokerage firm, on my floor, and they do client business. And I went in there yesterday, and they're watching ESPN, and there's no screens up. So, what is that? They're not even, forget selling, they're not even watching. So I think that no one's watching. And, if we go lower, a lot lower, maybe people will be forced out. But again, I appreciate you joining me. The insight is awesome.
Oh, anytime. Thank you so much for having me on. It's a pleasure.
No,
clear my thoughts. It makes sense for me. So anytime.
All right. Well, I appreciate it. Anything to close up, Mike? Or are we good?
No, it's good by me. Tony Greer, TG Macro, really appreciate it. Keep an eye on the markets. We'll be back to you guys soon.
Market up 500. Talk to you guys later. All right. Take care.